Hello, everybody. So I have a new forecast today, and I think there is a 70% probability the SPX reaches a new all-time high by December 31st, 2022. And so today the market is down around 2%. We're down around 12% from the previous high. There's a lot of FUD going on right now. There's a lot of inflation, 7.5% inflation. There's a lot of fear that the Federal Reserve will hike interest rates. There's a war in Europe, and there's a lot of sanctions on Russia, and we're worried that's going to cause a lot of oil and natural gas shortages and food shortages because of wheat and fertilizers from those regions. Oil is already really high. Natural gas is already high. A lot of commodities, especially food commodities, are up a lot. So basically, the idea is that this combined is all going to create a recession, a global recession. And while I think that is completely true, I don't think it's going to happen yet. So my second point that I want to make, and I hear this a lot, is oil prices have never spiked up this high without causing some sort of recession. That's not true. So I have here crude prices, WTI, pretty well-known index, and it seems more that, well, at least since 1986, there is a recession first and then high oil prices. So these gray zones mark beginnings and ends of recessions. And we see over here in 2008, oil was high, but, there was also points where oil was high over here, and that didn't really cause a recession, right? And oil was high over here. If you really think about it, it kind of doubled within 5 years, didn't cause a recession here. Oil went up here. This is like a 30% increase. Didn't cause a recession here. It's very hard to deterministically say for sure that high oil prices immediately causes recessions when oil prices seems to go up really, really high in the middle of a recession, not before it. If high oil prices causes the recession, we would see like this and then a recession over here. But it just doesn't seem. I just don't think that alone causes recessions. I mean, we would have seen that here, or maybe here, or maybe here. So I don't think that's necessarily true. And another concern is I don't know why everyone is so worried about this. I know there's a lot of geopolitical stuff behind it, and I'll get back to that. But Ukraine and Russia make up 1.9% of global GDP. So Ukraine's GDP, 155 billion. Russia's 1.48 trillion. That's the 11th largest economy in the world. And this is the global GDP. So it's such a small percentage of global GDP, and that's what we're all worried about. We should be more about China because they are actually slowing down, and that's going to cause a much greater effect. But the markets weren't really worried about that back in September or December. Sure, there was a little bit of a drawdowns, but it wasn't such a big deal. So I don't think geopolitical stuff matters that much when concerning with the stock market. Patterns in the U.S. stock market revolve around more around U.S. economics rather than geopolitics. So, for example, what's the most significant geopolitical event? One of the most significant events is the Cuban Missile Crisis back in 1962. That was over here. Sure, the stock market fell a little bit, but look what happened soon after. We just kept going up. We did like 100% return over the course of 7 years. And think about all the stuff with Iraq and Afghanistan, and then 9/11 over here. So and World War II happened over here back in 45, but that was like right before the stock market actually went up during the war. If we really think about it, between 42 and 46, I mean, we doubled pretty much. So the stock market revolves around economic cycles and economic patterns, not geopolitical stuff. So I understand that there's a lot of stuff and details about this war that I am not really appreciating, but I don't think that's going to affect the stock market, and it's going to cause a global recession. So a global depression is not here yet. It's definitely coming, but timing the top before a recession is very, very unlikely. I mean, when I'm talking about the top in the stock market, I'm talking about a top before a drastic crash like that or a drastic crash like that. And keep in mind, these are like 50, 60% moves in the market. saying that this is the top before we go down 50% like this, I say is highly unlikely. I do think we're going to dip a little bit, but saying that is the secular top in the stock market before a global depression, I don't think so. So a recession is not here yet. Yes, food prices and energy prices will go up. Yes, there's a lot of things going on, but I don't think things will immediately happen. Like, I think the timing is wrong. So I think, basically the default mode of the United States stock market is kind of go up. Well, of course, there are periods of 10 to 20 years where it kind of stays flat, but I don't think we're in that time yet. We're in that period yet. So unless a recession happens, massive crashes like these don't actually happen. So I must infer that the stock market will likely recover. Maybe not necessarily a new all-time high. That could be a little optimistic of me, but I don't think we're going to crash like 50%. So, if you really think about it, markets are simple. Just know when times are good and know when times are bad. And really the trick is having accurate indicators that tells you when we switch, when times are good and times are bad. So my accurate indicators are the 10-year and 2-year bonds. And so let me just show you that really quick. This is the 10-year yields subtracted by the 2-year yields. And basically it's like, historically, if we get below 0 on this indicator, then that means we're like between 1 or 2 years away from a recession. So gray bars are the recession. So we see, I've covered this plenty of times, but August 1978, 2 years later, 1980 recession. Over here, like August 1980 recession, June 1981, we went below 0 here, 88, and then 2 years later, and you guys get the point. You guys could check this out yourself. But again, I am talking about the stock market. So let's really look at this. So I promise you it's really accurate, but I don't want to go through all this because it's just going to take such a long time. So I'm just going to go over 2000, 2008, and the more recent ones. So in 2000, we hit 0 below 0 at June 1998. So within 2 years, we should see a recession. And let's see when the stock market actually hit its top. So June 1988 was around here in the stock market. June 1988. Yeah, right around here. So despite the 10th 2-year crossing, the stock market still went up, even though that's a really good indicator that a recession is coming soon. The stock market still went up until it peaked March. So around a year and a half later. So, even if it crosses, it still goes, the stock market can still go up. So December 2005 is when we inverted. So that was around here. And notice, yeah, sure, we could have a little correction over here, but the actual top in the stock market wasn't until October 2007. So almost 2 years later. So you kind of get the point. Like this 10 to 2 years is a really good economic or, a market indicator, kind of showing when a countdown is happening. When it crosses, you just kind of know that we have between a year or two before a market crash and a recession. So last time it happened was we hit 0. Well, we went below 0, but because it's a monthly thing. August of 2019. So that was August 2019. And yeah, you see, like, things at this period weren't looking too good. And a lot of people were calling for a recession. So, people were like, there's no way the market's going to go up. And the markets went up until, we actually got the market crash. So this was actually much sooner than most people thought. So basically, my point is that right now the spread is at 0.24. It hasn't hit 0 yet. So I'm not too worried that this is about to just tank. I think that it could recover. But, however, I would like to say that these economic indicators are not always accurate. So the 30 and 5 year used to also be as accurate as the 10 and 2 year. So same principle. Below the 0, and then 1 to 2 years later we get a recession. And if you notice the trend, it's like the bottoms are getting higher and higher and higher and higher until we actually came to a point where we didn't even get below 0. And so my concern is the same thing is going to happen with the 10-2-year, because we see the same thing happening. The bottoms are getting like higher and higher. Notice how the last time it happened, like we barely even touched it. We barely even touched zero. So, like, look at this. Look how far away this was from zero compared to all the other times. So I'm just worried that this could actually be the bottom right now, and we don't even know it. And yeah, I think, and actually in reality, we should be more concerned. We should be, so maybe the real indicator is when the spread bottoms, and just seeing it below zero and calling it an inversion is just an artificial metric. So yeah, the real important part is when it actually bottomed, not when it gets below zero, which is just an artificial metric. So yeah, basically my other indicators. So those were the two indicators, the 10-year, 2-year, and the 30 and 5-year, saying when things are good, when things are bad. And I think things are about to get bad, but they're not bad yet. Or maybe they are. I don't know. Maybe this is the bottom. So, my third one, of course, is the SPX Log Chart. Basically, it shows, when we hit these tops, that's when bad stuff happens. And we are not near the top yet, so I don't think bad stuff is happening yet. Maybe this is just a little dip. So, just a recap, this is 2000, this is 2008, this is like the 70s, or right when we started this inflationary period, and this is the Great Depression. So, kind of accurate, or not like super accurate, but it's definitely a good way of measuring where things are. And the Euro-dollar inversion. So this is from Jeff Snyder, and there's no chart for it that I could pull up, but basically he said the last two times it crossed was December of 2006, which is somewhere around here, and then it's kind of like the 10-2-year inversion, where it's like a countdown happens, where a year or two later things go bad. So last time he said it happened was December of 2006 and June of 2018. So right over here. So and apparently it just crossed again December of 2021. So that would put it around bad stuff happening, according to that indicator, at 2023. Okay, so basically, last thing I want to say is something about an interesting observation about gold. So if stocks go up when people are brave and want to make money, then gold goes up when people are fearful and want to make or preserve money. So I haven't really looked into gold, so this is honestly just an analysis of an amateur, to be quite honest, but I do think there's an interesting pattern here. So keep in mind, this is a logarithmic chart, because I like logarithmic charts. So basically, the reason why things are like this was because gold ownership was banned in like 1940 or something, and it was just legal to own at like 1971 or something like that. So there was a 40-year ban. That's why there was no like chart back here. Okay, so basically, a lot of people say gold. People hold gold when for inflation protection. That's not true. People hold gold when it's because it's correlated to real rates. I think the real reason why gold goes up in a fundamental level is when people are fearful of economic or geopolitical conditions and they want to preserve their money. So if you really put into that perspective, then it doesn't matter if it's because of inflation or because the rates are doing whatever, because of geopolitical stuff. It's because of fear. So I guess this is like a VIX kind of, VIX, which is like a volatility index. So basically, this was this was during a great inflationary period in the United States. There was a lot of bank lending, but also there was a big oil crisis. There was a lot of stuff going on where oil prices were going up massively. So inflationary, a lot of fear, so people held gold. And keep in mind, when that went away, when times started getting good, so the 80s was pretty good, the 90s were pretty good, the gold prices went down because I'm guessing fear was down. And stock market hit its peak over here, and the recession happened, and in 9/11 and Afghanistan and Iraq and all that stuff. So I guess fear started going back up, and so people started buying gold again. This was 2008 when a giant economic crisis happened. So you could say this breakout in gold was kind of like forecasting that. And there was, even though the stock market bottomed around here in 2009, gold kept going up because I'm guessing fear was still very high. But eventually it went away, and stock market and things went back to normal and things went good. And so gold started going down. And until just recently, not recently, but July 2019, gold broke out, kind of forecasting a recession and maybe even something happening. And so that's why it went up. And then, so basically, I'm going to, so basically my point is that basically gold goes up when people are fearful. And the fact that gold is going back up again and breaking out of its, low areas or consolidation shows that fear is back on the table. And it's like an early warning indication, much like the 10, 2-year and all that other stuff that I talked about, that things might not get too good soon. Because, whenever gold went up, it was kind of forecasting that a bad period is going to happen. So, it was accurate. It was kind of like accurate here when it started going up. It was accurate here in 2005 when it started going up. And it was accurate here in 2019 when it started going up. So I would not ignore this signal. So, but I really want to show something really interesting. Okay, so there's a period of, so if you follow my channel, I keep talking about how there's periods of overperformance and periods of underperformance in the stock market. I went over it so many other times, but basically it's like a cycle of 10, 20 years of overperformance and 10 to 20 years of underperformance. All right, so basically gold actually really correlates with that. So during the 70s, it was actually a period of underperformance in the stock market. So the stock market, this chart is not a logarithmic chart. Basically, it did doo-doo until around 1980, 1982. Then that's when the stock market started going up. So people started becoming brave and started wanting to make money because things started turning good. So people sold their gold and then they started buying stocks. So this drop in gold kind of marked the period of overperformance in stocks. So gold went down, stocks went up. Okay, so when stocks hit its peak and now there's a period of underperformance, which it did for around like 10, 20 years or around 10 years, that's when gold started picking up. So notice how when stocks started to really drop here and then marked a period of underperformance, gold started to really pick up. And so gold kept picking up until, notice how we didn't really hit a new high in stocks. So this was 2000, this is 2008. Think about all the bearish sentiment during this time. People thought the world was going to end. People thought capitalism was going to end. And so people didn't really start getting hopeful again until I think around like 2012, right? Like that's when people started going like, hey, things aren't that bad. I could buy houses again. The economy, kind of recovered. And so fear went away. So during this time, people still thought things weren't that good. And that's why people still kept accumulating gold, I'm guessing. But when it became clear that the stock market was recovering pretty well, I'm guessing, now it's time to be brave. Now it's time to put risk on the table. And so stopping fearful, they sold gold and started buying stocks. So now this marked the period of overperformance. So notice there was like a 10, 15 year of underperformance, 10 to 15 years of overperformance, 10 to 15 years of underperformance. So you could guess what happens next. A 10 to 15 years of overperformance in stocks and thus an underperformance in gold. So this entire period, stocks were just going up and up and up and up. So people didn't really want gold. So when you notice that the gold price started going back up over here, that was like, wait, something is happening. And then boom, COVID. And so notice how like when people were really worried about COVID, right? People thought like, oh my God, we're going to so much uncertainty, so much FUD, so much stuff that I don't know about, just like right now. Gold started going down. Gold was up, but then it started going down when people started going like, wait, the economy is recovering. Wait, the stock market is going up. Wait, the Fed's got our backs. Stocks go up, stocks go up, stocks go up, stocks go up. And so gold went down. And so now you see gold going up. And then now our 10 to 15 year period of overperformance is kind of closing to an end. As you can see from the Spx logarithmic chart, we're about to hit the upper end of this ghetto logarithmic band, and we're about to hit the bottom of the 10 year 2 year spread. Like all of these things are kind of like pointing at a certain direction that things are not going to be good. But does that necessarily mean things are not going to be good this year? I don't think so, because Well, you might think like, okay, so this entire time you basically told us things are about to get really, really bad. So why are you bullish for 2022? Well, if you really look at it, the gold is often really early. So you could see like, if you really look at this giant consolidation, like things, we didn't really hop out until like, 2005, 2006. That's when gold really started moving. But look at the stock market. The stock market still went up, right? And then you could see even after the stock market did a giant crash, people were like, okay, gold went down. But then gold started going back again. So people were like, oh my God, so things are going to get bad again. But the stock market went up. Same thing over here. There was this long period where gold pretty much didn't do anything, and it started breaking out June of 2019. And people must have thought, oh my God, so that's it for stocks. It's over. But it still went up. Like this period over here, I know it doesn't look like much, but let's go back into it. So this was like after 2018, the market crash. So that is this over here. And this was a good like 23%, 25% move up. Like it was still a bull market. So I'm saying, I know it's like really risky, but from my point of view, I'm 21. I don't really have a lot to lose, and I'm willing to put on a lot of risk. Just because gold is starting to go up doesn't mean stocks are going to fall immediately. In fact, I do think that this is because this is an early warning indicator. I do think stocks are going to sort of recover back to all-time highs. So I know this was a long video, and I'm sorry if I didn't explain it as clearly as possible. If you have any questions, please leave a comment. But in conclusion, I think a recession stock market crash likely won't happen in 2022, but it is likely between 2023 and 2025 due to all of the indicators that I went over. And in the next few months, I do think stocks go lower. I do think that is entirely possible. Remember, we're only down around, I think 12% from the peak. I think we could go down to 20%. And I do think that does mean that it's going to take Bitcoin with it, and Bitcoin is also going to go down. But, stocks, I think it hits new all-time highs in 2022, goes higher until it ultimately crashes later in the next year or something. But the last point I do want to make, I do have most of my money in crypto right now, and I was literally about to sell everything yesterday. I was like literally a button away from selling everything, but I realized that I cannot time things correctly, and I think it's better to just sit on my hands and not sell anything, because if the stock market is going to go down, I know almost for a fact that Bitcoin is also going to go down. Specifically, I think Bitcoin can reach the 200 weekly moving average. That's historically like the bottoms of Bitcoin's bear markets. And there's a lot of uncertainty, and I do think we could really get down here. So I'm looking at a 50% drawdown in Bitcoin, but I didn't decide to sell it because, accurately timing the bottoms and tops during such a volatile period like this is it is pretty much impossible. So I decided to do nothing. I'll eat the loss, whatever. So this is not a forecast I'm making because I have no clear signs of it. But I am hoping that when the stock market recovers back to all-time high in 2022, hopefully it takes Bitcoin with it, and Bitcoin also recovers back to all-time highs. But that's kind of like, I don't know. I don't really have any real good evidence for that, so I'm just hoping for that. So that's why I didn't want to make a forecast saying Bitcoin's going to go up, but I'm pretty certain that the S&P 500 will reach new all-time highs by December 31st, 2022. However, I do want to reduce the probabilities of Bitcoin peaking at 2022 from 90% to 80%, and I want to reduce the probability SPX reaches 5,500 points from 70% to 65%. So these are the changes I made in my forecast. I said I would change them. I don't like just keeping these forever. I do want to change these around when I think I have enough new information to properly change things. And when I talk about new information, I'm not talking about FUD or noise or whatever. I'm talking about actual things that actually impact the markets. So I know this video was long, but long story short, I think short term stocks go down, then stocks go up, then stocks go down, and things get really bad. So I hope you guys liked the video. Please like, please subscribe, and I'll see you guys next time. Bye.